Hello everyone. In this recording we're going to go through some of the homework for Chapter 7. And Chapter 7 is when we started to look at the variances. Once again, the variances is the difference between the actual and the budgets. We talked about sales volume variances, which is simply the difference between the static or the planning budget as well as versus the flexible budget. And the flexible budget variances, also known as the expenditure variances, revenue and expenditure variances. This is the difference between the actual results and the budget flexed to the actual level of activity. So in this example, we have a company, Sweeney Enterprises. They manufacture tires for motor racing circuit. For August, it budgeted to manufacture and sell 3,600 tires at a variable cost of $71 per tire and total fixed cost of $55,000. Okay, so basically what we're talking about here is this last column, the static budget column. The units sold, it was budgeted for 3,600. Okay, and the budgeted selling price was $114 per tire. So if you take 3,600 times 114, that would give me the budget for the revenue, the static budget. All right, and the variable costs are budgeted to be $71. So if you take 3,600 times 71, you'll get your variable costs. Revenues minus variable costs gives you a subtotal called contribution margin. And the budget for fixed costs was $55,000. If we take our contribution margin, subtract out fixed costs, we will get operating income. So once again, the static budget is the original planning budget based on what we intend to sell. Now, the difference is with the flex budget, what we are going to do with the flex budget is basically we are going to flex or change the budget based not on the 3,600 units that we were originally planning to sell, but the 3,500 units that I actually sold. All right, so that's really a changed budget. So we can better compare the flex budget for this level of activity to the actual results. As I said in the lecture, it's like comparing apples to apples. Instead of comparing apples, which is the 35 units actually sold, to oranges, which is the 3,600 we were planning on selling. So we take our flex budget, 3,500, and multiply it by budgeted revenues of $114 per tire. You'll get your $399,000. If we take our 3,500 units sold, times our budget for variable cost of $71 per tire, you'll get your $248,000. And for fixed costs, well, it remains the same. That's the budget. For fixed costs, it really has nothing to do with number of units sold. Fixed costs remain the same in total, regardless of activity level. And then our actual results, the author said that the actual selling price was $116 per tire instead of $114. So the revenues are actually 3,500 times 116. Because our selling price actuals were higher than what we were budgeting for, this is a favorable variance. Variable costs, it said our actual variable costs were $280,000. The author gave that number to us up above. And then, of course, our actual fixed costs we said were $51,000. So the overall variance, all right, which is the actual results, $75,000 versus the overall static budget, $99,800. We have an overall level 1 variance. It's unfavorable. But when we flex the budget, and basically we have the difference between $95,500, which is the operating income we were expecting at the 3,500 unit level of activity, but we only got $75,000 in operating income. So the flex budget variance, which is the level 2 analysis, $20,500 unfavorable variance. And that is something that would need to be analyzed and figure out why is it unfavorable. And from here, we would do a level 3 analysis where we would do basically our cost. We would break up our costs between price and efficiency variances to get to a more detailed look at why our variance is what it is. Okay, and basically what we have here is pretty much the same. You can see the author was giving us our actual results in the far left-hand column. In the far right-hand column was the static budget. But in this case, we had a new accountant intern. They were very nervous. They started their first day on the job, and they accidentally deleted the calculations in this variance analysis. You can imagine how embarrassed they must feel. But basically, because the first column and the last column were not deleted, we can still figure out the middle part, which is the flex budget. Okay? All right, and so basically this is the way it works. Okay, so the static budget, which is what we were anticipating selling, 120,000 units, we actually sold 130,000 units. So the flex budget, which is missing, remember everything here in gray was missing. It was deleted by the intern, the accountant intern. We know the flex budget is going to equal the same, the activity level, the same as the actual results. That is the whole idea of the flex budget, to flex it or change it to the actual results, not what we were expecting originally to sell, the activity level in our planning budget. So revenues. How do I figure out what the flex budget revenues are? Well, it's going to be the actual units sold, which in this case was 130,000 units, times our original budget for sales price. Well, originally, if we had $420,000 in our expected revenue divided by 120,000 units, our budgeted sales price is $3.50. Well, if I take that $3.50, which was the budgeted sales price, times the actual unit sold of 130,000, we are going to get the $455,000 as our budget for the revenues at the actual level of activity of 130,000 units. The variable cost, once again, if we take the static budget of $240,000 divided by 120,000 units, that is a budgeted variable cost of $2 per unit. If they take the $2 per unit and multiply it by the actual activity level of 130,000 units, that's where you'll get your 260,000. Okay, so revenue less variable cost will give you the contribution margin. Contribution margin less your fixed costs. And the budget for fixed costs, static and flex, should be the same, right? Because it's not based on activity level. It's based on, this is the total, regardless of activity. Subtract the fixed cost from your contribution margin, you get operating income. And of course, the difference between the actual results and the flex budget are called the flexible budget variances. And the difference between the flex budget and the static budget, they are called the sales volume variance. So let's take a look at the sales volume variances first. We were originally expected to sell 120,000 units. Well, we sold 130,000. That is a favorable variance by 10,000 units. Notice this first line item is, they're not dollar amounts. We're simply, in the first line item, we're talking about units. Now come the dollars. So originally we were expecting to have revenue of 420,000. We actually had to flex the budget based on actual level of activity, 455. That is a favorable variance because revenue is higher with the flex budget than the static budget. Variable costs are also higher with the flex budget than the static budget. Because the cost is higher, that is an unfavorable variance. Contribution margin, using the flex budget, 195, versus the static budget, we were expecting 180. It is higher than what we were expecting. That is a favorable variance. In the overall operating income, flexing to the actual level of activity, $75,000, but our original planning budget had $60,000. That is a favorable variance. And you do the same analysis with the flex budget analysis. Compare the actual results to the flex budget. Revenue is a lot higher than what we were expecting. That is a favorable variance. And costs are higher than what we were expecting. That would be an unfavorable variance. And so we would need to go through this and figure out why the variances are what they are and make decisions as to why they are what they are and incorporate that, investigate, and of course incorporate that into our future budget models. All right, so basically what we're going to do here in this homework problem is we're going to do a level 3 analysis. We are actually taking a look at the differences between the actuals and the flex budget. When we take a look at the differences between the actuals and the flex budget, this is basically the flex budget variance, just like we saw in the last homework problem. So with the level 3 analysis, what you're going to do is you're going to break up the flexible budget variance into 2 pieces. And those 2 pieces are price variances and efficiency variances. This is one of the more important parts of this chapter. So really what you're going to do is you're going to do that 3-column approach that you learned in this chapter. The far left-hand column is basically going to be the actuals. So as an example, let's take a look at materials first. We're going to look at materials and labor. Looking at materials first, we can see that the actual costs for materials were $200,000. All right, that is the far left-hand column. The far right-hand column is going to be basically the flex budget, so which is really the budget for the actual level of activity, all right, times the budgeted price. So in this case, we have $225,000 if we take our actual inputs for this level of activity that's allowed times the standard price, it comes to $225,000. The difference between $200,000 and $225,000, that $25,000 is the flex budget variance, all right, which I'm highlighting here on the left. What we're going to do is we're going to break up that $25,000 favorable variance because the actual costs, $200,000, is much less than the cost for materials that we were expecting for this level of activity. All right, so how we're going to break up this $25,000 flex budget variance is we're going to put in a middle column. And once again, this is a 3-column approach that we learned in the chapter. That middle column is going to be the actual inputs, all right, so the actual quantity, if you will, times the budgeted price or the standard price. In this case, that's $214. So if we compare the $214 to the $200, the difference is $14,000. And the reason why these two numbers are different, they're both taking the actual inputs, but the difference is the price. With the actual price, you got $200,000. With the standard price or the budgeted price, you got $214. That is a $14,000 price variance. And because using the actual prices came in lower than the standards, that's why it's called a favorable variance. Now the efficiency variance, you're going to compare the 214 to the 225. Remember, the 214 is based on the actual inputs times the standard prices. And this 225 is based on the inputs that's allowable for this level of activity, all right, which is different than the actual inputs. Using the actual inputs, it came in lower than using what we were allowed for that level of activity. That is an $11,000 difference, and it's a favorable variance, meaning we were very efficient with our materials. Our materials cost less than what we were expecting, That's the price variance. The difference, you can see, is in the actual prices versus standard prices. And we were very efficient with our materials on the assembly line. We only 214 versus 225 is what we were allowed for that level of activity, but it came in less. So we were very efficient. We do the same thought process with the labor. So the difference between the actual labors, which is $90,000, and the budget, the flex budget for this level of activity is $80,000. So the overall flex budget variance, $90,000 actual, $80,000 budget for this level of activity is $10,000. And it's unfavorable because the budget is less than what we actually incurred, $90,000. Now, once again, breaking up this flex budget variance into two pieces, we're going to throw in this middle column. And the middle column is going to be the actual hours times the standard rate. So when you compare the 90,000, which is based on actual hours times actual rate, and the 86,000, the actual hours times the standard rate, you could see using the actual rate, it came to $4,000 more. That is an unfavorable rate or price variance. And then compare column 2, 86,000 to the 80. The difference, once again, is the 86,000 was based on the actual hours. The 80,000 was based on the hours allowed for this level of activity. Those are two different things. And using the hours allowed for this level of activity came in less than the 86. That's also known as an efficiency variance, and it's unfavorable because we spent more hours, all right, more hours than what we were supposed to. We were inefficient with our time. So once again, this homework problem is going through a level 3 analysis. I refer you back to the level 3 analysis 3-column approach that you learned in this particular chapter. And this is definitely the highest level of analysis that we've done for both materials and labor. We will check on the overhead variance in an upcoming chapter. Okay, so what we have here is we have a Rugged Life Inc. They design and manufacture fleece quarter zip jackets. All right, and so basically what we have here is it looks like we have, we sell our jackets in lots. One lot is 1 dozen jackets. So the author gave us information. Let me put this up here so we can see it. Let's see how far I can go here. Okay, so the author told us that the static budget, all right, remember the static budget is is the planning budget, the original master budget, all right? We were planning on selling 300 jackets. And the original budget had standards of materials, 18 yards at $4.65 per yard, or a total direct materials of $83.70 per lot. And remember, each lot is a dozen jackets. And the materials, the labor, 2.4 hours, and we're paying standard $12.50 per hour. So the standard or the norm for labor is $30 per lot. That's not what actually happened. Let's take a look at what actually happened. So how many lots of jackets did we actually sell? 325. We were expecting 300. Okay, so when we fill in the formula here, over here in the left-hand column, we're going to show 325 is the actual number of lots of jackets that we sold. And the flex budget, this is what we're doing. We're comparing the actual results to the flex budget. We're doing a level 3 analysis in this example. And so you're going to see that when you're comparing your flex budget to your actual results, it's the same number of units. That's the whole idea. We are flexing to the actual level of activity. All right? We are changing the static budget to the actual level of activity. All right, now what we're going to do for the actual results, we can see that actually, what did we have? Actual direct materials, the author tells us, is $31,525 in direct materials, and direct labor, actuals, $9,009. So these are the actuals. Now come all the way over here to the far right-hand column, and let's fill in the flex budget for materials and labor. Okay, so first of all, for direct materials. With direct materials, you could see the flex budget is $27,202. Well, how did we do that? Well, we're going to take our actual level of activity of 325 times the budget for the direct materials. If you recall, we said the budget was $83.70 per lot. So we should have spent $27,202.50 on the materials for this actual activity level, 325 lots. Same thing with labor, 325 lots times the budget for the labor, as the author said, was $30 per lot. That works out to $9,750. So if you compare the actual results to the flex budget, you have the overall flex budget variance. Now what we're going to do is we're going to throw in this middle column where we're going to steal the actual quantity from column 1, and we're going to steal the budgeted price from column 3. So let's take a look. How did I get this $30,225? Well, that is the actual input. Okay, you can see the actual input was, for materials, 6,500 yards. Okay, here it says 6,500 meters. That meter should be yards. A little typo there. 6,500 yards times the budget price. And we saw that the budget price was $4.65 per yard. That's where you get your $30,225. So once again, we took our actual input or our actual quantity from column 1, and we took our price from column 3. So when you compare column 1 to this middle column, the actual quantity is the same. The difference is in the price. That's why this is called a price variance. Comparing the actual $31,525 to using the budget price, $30,225. When we use the actual price, it's higher. That's why it's an unfavorable variance. Now compare column 2 to column 3. You could see when we use our actual quantities, it came in higher than when we use our standard quantities. Therefore, it's an unfavorable variance. We do the same thing with labor. So let's take a look. How did we get the $8,937.50? We're going to grab our actual hours, okay, we're going to grab our actual hours from the actual results. So let's take a look. We have the actual hours, we said, were 715 hours. Okay, that should be here. Here it is. The actual hours were 715. And the budget price was $1,250. All right. That's where you get your $8,937. When you compare column 1 to column 2, the actual hours are the same. The difference is in the rate. All right. So when we use our actual rate, we're a little higher than the standard rate. That's why it's an unfavorable variance. And you compare column 2 to 3, you can see the difference between column 2 and 3 is with column 2, we're using actual hours times the standard rate. Here we're using standard hours. When we use standard hours, it's higher than the actual. That is a favorable variance. We were efficient with our labor time. We used less hours than what we were anticipating for this level of activity. And this is something that we would need to analyze a little further. Once again, this is called a level 3 analysis. And last but not least, in this chapter, we are taking a look. I'm only going to look at option 1 in this homework chapter, homework problem, where we're actually recording the journal entries. For those of you with a textbook, the journal entries are laid out on page 262 and 263. All right, now what we have here, you can see for how we're going to record the journal entries is as follows. All right, so the author tells us, let me see, let me click on here. Here we go, option 1. All right, perfect, option 1. You can see we've got our 3-column approach here. So column, really our level 3 analysis, if you will. In column 1, we have our actuals. So our actual cost for materials and labor. Over in column 3, we have our budget for this level of activity. So for this actual level of activity, we were budgeting or allowing $36,300 for materials and $11,550 for labor. Now we throw in this middle column where we're going to steal the actual quantities from column 1, but the standard prices from column 3. All right, and so column 2 is kind of like that combination column. And now we can compare column 1 to 2. The difference is the price. Therefore, that's called the price variance. And the difference between column 2 and 3 are the quantities. That's why we call the difference between column 2 and 3 the quantity variance. So how do we actually record the journal entry? We've spent so much time looking at variance analysis. We really haven't paid attention to the actual journal entries that are made. Well, the first journal entry when we record the actual materials usage is basically we're going to take a look at this. We are going to credit the accounts payable, $35,340. I want you all to match it up with our analysis table. The credit to accounts payable is going to be, and this is logical, the accounts payable credit is going to be the actual amount we need to pay our vendors for the materials purchased. Well, that's the first column, the actual cost. So I'll credit accounts payable for the full $35,340, the actual. But I'm only going to debit the direct materials. This is how we actually record it. We're going to debit the direct materials for the actual quantity used times the standard price. We always base our journal entry for materials based on the standards. So the actual quantity purchased or used times, in this case the same as purchased, actual quantities purchased times the standard price, and I'm highlighting the number over here, 34,100. The difference between the two is your price variance, and that'll be recorded as a debit. All right, you can see unfavorable variances always have a debit balance. In this case, the unfavorable variance has a debit balance. Now what happens? Now let's take a look at actually taking the materials and taking the direct materials purchased and moving them onto the assembly line. That is the next step. When we move the materials onto the assembly line, we are going to increase the WIP account. Work in process control, remember, this is an inventory account, and the inventory account will be debited for the flex budget amount, which is basically the amount allowed for this level of activity, all right, times the standard price. So the standard quantity times the standard price. We will put onto the assembly line based on the standards for this level of activity, 36,300. But how much direct materials came over? You can see the 34,100. The difference between the two is the efficiency variance. And you can see this efficiency variance is a favorable variance. It's got a credit balance. Why is it favorable? Because the direct material cost using the actual input is less than what we were allowed to for this level of activity. So we were very good with our materials. Now let's take a look at the labor, and we are done. So the labor, how much labor was allowed for this level of activity? $11,550. That will be the debit to the WIP, very similar to the debit to the WIP account for the materials. It's based on the flex budget, the amount allowed for this level of activity. But what is the actual labor cost? $9,844. That's going to be the wages payable. That's what we're paying out to our employees, the actual. So once again, we're going to throw in this middle column, which is we're going to steal the actual quantities from column 1 and the standard rates from column 3. And so the difference between column 1 and 2, the difference is in the actual, the difference is in the rate. The actual hours are the same. The price is different. The actual cost, we're using the actual pay rate. In column 2, we're using the budgeted pay rate. So using the actual pay rate, we're a little higher. We're $184 higher using the actual. So the rate variance or price variance is unfavorable, debit. That 184 is the difference between the 9844 and the 9660. Now we compare column 2 to column 3. Column 2, we were using the actual hours and budgeted price. Column 3, we're also using the budgeted price, but we're using not the actual hours, but the hours allowed for this level of activity. You could see we came in a lot lower at using the actual hours. So we were very efficient with our time. The difference between the 9,660 and the 11,550, the difference is 1,890, and that is a favorable efficiency variance. That's why it'll be a credit balance. And basically what we do at the end of the period is we are going to close out our all of our price variances and our efficiency variances. They will all get closed out to cost of goods sold. We close out all variances to cost of goods sold, assuming they are immaterial in nature. And that's exactly what we have in this case. All right, so once again, make sure you understand how to record the journal entries for buying the materials, entering into the wages, and how to apply the materials and the labor to the assembly line, which is the WIP process. And this last homework problem I wanted to go through with you, it's really fairly simple. The author gave us the actual results, which was column 1, gave us the flex budget, which is column 3 here, and then column 5 is the static budget. This is an overall performance report. Basically, when you have all of these columns together, the difference between the actual results and the flex budget are the flex budget variances. And just so you can piece this all together, these flex budget variances in a level 3 analysis, they are broken down between price and efficiency variances, which we practiced in prior homework problems. And then the difference between the flex budget and the static budget is simply the difference in your units sold. That's why we call them sales volume variances. This homework problem, basically, you basically just needed to put in the variances and whether they were favorable or unfavorable. So as an example, actual revenues are lower than the flex budget. That's unfavorable by $28,000. Actual variable costs are higher than the flex budget. That's unfavorable. Contribution margin is lower than the flex budget by $34,000. That's unfavorable. And the fixed costs are lower than what was budgeted. That's favorable. And you do the same analysis with the sales volume variance.